This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Rob Schultz of Serra Ventures. Rob, thank you for joining us.
Thanks for having me.
Can you tell us, Rob, how you got into venture capital business?
Sure, Hall would love to. I think it's a great question because I think every venture capitalist you talk to has a different path that they ultimately became a VC. There's kind of not a cookie cutter, so I get asked that question quite a bit. And actually got into the VC world very much like my partners have, is a belief that kind of former entrepreneurs kind of make the best venture investors, especially at the early stage. So myself, like my other three partners, were former the VC-backed high-tech entrepreneurs. I ran after business school at the University of Chicago, started a company from scratch called DigitalWork in the late 90s and grew that very rapidly, venture-backed, and ultimately took it through an IPO process in early 2000 to be kind of Heismaned, if you will, by the NASDAQ crash and the crash of the stock market in 2000. So we didn't make it public, but had a great experience and ultimately found a nice soft landing for the business. Given that experience, was recruited to help the University of Illinois start a venture incubator, if you will, to help commercialize technology that was invented at the University of Illinois here, basically in central Illinois, Champaign-Urbana. It's a leading computer science university, leading engineer university, so a lot of really relevant cutting-edge technology and intellectual properties developed here. So I was recruited down to Champaign to start a venture incubator that was really focused on starting businesses from scratch using technology that was invented at the University of Illinois. So that was kind of my initial foray into the world of venture capital.
And tell us more about Serra Ventures, where you're working now. What's that group all about?
Yeah, and that's a next kind of chapter in the story. So moving down to Champaign in 2002 with a mission to fund Illinois-based technologies, I met up with a gentleman named Tim Hare that had just licensed some technology and built a company called Eyesight Mission Technologies, which was a company that focused on new ways to sort cells, much more cost-effective and faster, basically a faster, better, cheaper way to sort cells for a number of use cases, including kind of research on cells from a life science perspective. That was my first investment coming into Champaign, and sat on the board with Tim, and ultimately had a very nice exit to Sony in 2009, which quickly became Sony Biosciences. So Tim and I at that point had been working together for almost 10 years. And after that experience, like a lot of startup CEOs that have a nice exit, they look for something else to do. And Tim started Serra Ventures and raised a small fund, Serra Capital One. And I was still at Illinois Ventures at the time. And we continued to invest together in the Champaign ecosystem. And Serra decided to raise two, and I had left and joined another startup, if you will, another entrepreneurial venture, which had become Serra Ventures. And at that time, Dennis Beard, our third partner, who was also an investor in Eyesight from Open Prairie Ventures, came on. And that was really the beginnings of Serra's development as a kind of a Midwest-focused venture capital firm, was Serra Capital 2. And we began to expand our thesis outside of just Champaign and the ecosystem here in the research park, which now has an incubator with well over 30 companies, a couple dozen Fortune 500 companies, and about 1,500 to 2,000 employees in the park itself. So it's grown quite a bit.
So you focus on the Midwest region. What criteria do you look for companies in that region itself that is a good fit for Serra Ventures?
We're an early stage investor, Hall. So we're not doing necessarily kind of back and napkin seed deals. I'd say the easiest way to kind of characterize a company that we would become interested in, or at least take a look at, is usually one that's been through an accelerator program like a Techstars or Ocean or a Generator that has established a solid product market fit approach that's demonstratable. Early revenue, we don't have a hard and fast, you have to have $1 million of ARR to kind of meet our criteria, but we do look for revenue that's kind of on model, we call it, meaning you just didn't get a board member to get, a couple of their friends, or really something that can demonstrate the unit economics of the business. And then we look for strong management teams, obviously, either from a technical perspective or industry, someone that basically has got the story. Hey, I saw this problem in my industry and no one was solving it, so I left and started this company. So we look for teams that have kind of a strong either industry or technical background to go along with a strong product market fit and early revenue.
So it sounds like you do a broad range of sector deals, tech, healthcare, consumer, et cetera, as long as they've got a little proof of concept, product market fit of some kind, a little bit of revenue. It sounds like you're in the game for it. Is that right?
Pretty much. Yeah, I'd say we're more generalists. Some of the things we do tend to stay away from are the kind of the consumer-facing apps or software systems, if you will. If you look at the backgrounds of the partners, we just don't really have a lot of skill in really helping those businesses. So on the software side, tend to be more B2B, oriented companies. We do med device and research device, kind of leveraging off of Tim's background, as I mentioned before. And in another sector that we're pretty active in, especially in our Fund 3, has been agricultural technology, so known as ag tech, which the reason being is because that's where we're located, kind of in the heart of ag country. Here in the research park, there are many, many ag companies ranging from John Deere to ADM to Dow to Bayer. They're all here granular in the park. So we've got access to some tremendous resources to help source and vet opportunities in ag tech as well.
What are some of the trends in the ag tech space? It seemed like it's coming up pretty fast compared to other sectors. What are you seeing out there for it?
Yeah, definitely. I'm not going to say it's been an old space where you've seen kind of a number of trends that have kind of beginning to mature, ranging from what we call precision ag, which is helping farmers do better in their fields. So we tend to think of, row crops, soybean, corn, and the like, and other row crops, helping them do better with yields by managing their farms on a smaller basis. So from things like deciding when to plant, what seed, how much nitrogen to put down, how to maintain the field during the course of the season, and when to harvest. There's cutting edge technologies that are helping farmers manage their farms with better weather imagery and data analytics to do a better job at that. We've got a company here in the research park called Agrable that's a leader in that area. So, that's one example of, I think, a pretty hot trend. It's being well invested and becoming well adopted by the farming community.
That sounds great. And of course, being in the Midwest, there's many kinds of companies, and it looks like you cover a fairly broad number of states in the Midwest. It's not just in Illinois. And so it seems like you have access to quite a few deals that are probably looking for venture capital. What's your take on the Midwest region as far as capital ready or companies ready for venture capital?
Having been in the Midwest my whole life, and more specifically in Champaign, college town, as I described it earlier, with a lot of innovation, I couldn't be more bullish looking forward, over the next 10 years. It's really beginning to hit its stride in terms of just creating more solid venture fundable deals. And it's not just in the Champaign Research Park. We've observed areas like Cincinnati and St. Louis and Indianapolis and Lincoln, Nebraska, Madison, Wisconsin, and the like. And it's a confluence of a lot of factors. One is would-be entrepreneurs or being through these ecosystems better educated. There's more resources available through programs like we've talked about, and these accelerators like Techstars and Generator, internal university programs like the I-Corps that are running educational programs on new methods like lean startup. Companies are coming out a lot more customer focused than they were in the past. And then just the characteristics of the Midwest, I think, is really exciting. Obviously, you've got a little lower cost of labor and opportunity to retain the best people that want maybe a different lifestyle than they'd find in the East Coast or California. So the types of people you can get, I think, are affordable. You're less worried about a Facebook or a Google stealing them, in Champaign-Urbana or Madison, Wisconsin, than if you were sitting in Menlo Park, California. So a little bit better to manage and build a strong human resource asset in the Midwest makes it a really exciting place.
Well, how do you translate those benefits you just mentioned to pre-money valuations on the deals? How does it compare in the Midwest versus the West Coast on pre-money?
Yeah. It's we're not necessarily combing for deals on the West Coast. I can just kind of tell you what I read, but I think we don't see the gyrations and valuations like you might see in the West Coast and the East Coast. Our model, our typical entry point is, a $4 to $7 million pre-money valuation, which I think is a fair one given the milestones that I described before, that enables us to find plenty of good opportunities that fit our model. I think it's important for entrepreneurs to understand the kind of venture funds that they're wanting to partner up with and understand their models. And for our model to work, that's kind of an entry point that works well. We're entering it at that valuation. We're also can make our model work on exits that are maybe less than a West Coast firm would kind of demand. So a $60, $70 million exit still works very well for our model and the entrepreneur, versus, needing to kind of go for the unicorn type approach in the East Coast and West Coast models.
So certainly a lower cost of living stretches your investment dollar a lot more. We see maybe a 20 to 30% stretch here in Texas. What are you seeing there in the Midwest?
Yeah, it's cost of living, and then I think attitude and approach of the entrepreneur. There are different styles to grow, the business. So we're seeing rounds $1.5 million to $2.5 million. We like to see that lasting, 14 to 18 months. We think that's a good first round of capital in which a company can meet all the requirements to kind of get ready for the next round of capital.
So you guys are in the early stage. What happens when they get to the next stage, looking for a Series B or C at that point? I guess at that point, are they still in the Midwest, or are they now looking further afield for those investors?
Well, we've seen a combination of both. We've certainly had some West Coast investors invest in some of our companies, but there's Series B. In fact, I think that's maybe more of the sweet spot in the Midwest in terms of less venture capitalists, if you will. So assuming that the startup can stand on its own merits, have solid metrics, I think availability of capital at that stage is not a problem.
So shifting gears a little bit, when companies come to you and they want to raise funding, of course, you get people that are all over the scale there. What do you wish they knew before they came in to ask you for funding? What do you wish they had done before they showed up for the deals you're seeing come in your door?
That's a good question. I think doing more homework on us, I think is important. We get approached. You did your homework, Hall, and you know that we're a Midwest investor, which I think you just have to read the first page of our website to understand that. But, we'll still get approached from foreign companies or, companies in New York. So, just doing some basic research on people and the fund that you're talking to, I think goes a long way. Also understanding the stage that we're at and doing a little bit of research on the market. So, and like you did, so our entry point, what we're typically investing in. So don't bring us an oil and gas deal where you're looking to raise $150 million, right? So I think just kind of basic screening of the venture firm that you're looking at goes a long way versus just taking a shotgun approach.
Absolutely. It seems in the early stage we're trying to find the product market fit. What can you guys do to help those entrepreneurs solidify that position as they come in to raise funding and then grow through that seed and Series A? What are you helping them with on that front?
Sure. A lot of it's asking the right questions and being the right coach and helping introduce the right processes. Hopefully the entrepreneur has an understanding of the problem they're trying to solve. Otherwise, they would be passionate about the problem or passionate about the business they're trying to start. If that's not the case, it's probably not a good fit for the entrepreneur. So our belief, as I mentioned, at the beginning of our talk, we're all former entrepreneurs ourselves. So, we're kind of sports fanatics. So we think the best coaches had been on the field before, and that's us. So to be a good coach, you got to be able to ask the right questions, know when to push the entrepreneur to do more, know when not to. So that's really where we're going to bring a lot of value in the early stage, being able to provide answers and give feedback based upon experience versus reading a book.
It's great. In the minute or two we have left, what else should we talk about that we haven't about operating a VC firm inside the Midwest?
Yeah, I think, the other thing that's a mystery, you can talk about returns. We wouldn't be doing this unless we thought that there was an opportunity to create, venture style returns. We're not doing this we're having a blast and it's a lot of fun. But for, potential LPs that are listening to your podcast, I'd challenge them to do some homework and take a look at really what's going on in the Midwest and do it on a kind of region by region basis and look at some of the exciting exits that are happening and the unique opportunity. I think for an LP out there, Midwest is a great place to have a couple of venture assets in, because again, venture cycles over the longer term, and I think you're going to see some exciting world-changing companies come out of the Midwest.
Well, that's great. So what's the best way for the listeners to get back in touch with you? Your website, LinkedIn, or what works best?
Yeah, my email address is rob@serraventures.com. That's probably the easiest way to find me.
Great. We'll put that in the show notes and let people get back in touch with you directly, and also your website so they can learn more about what Serra Ventures does as well. Appreciate your taking time and hope to have you back for a follow-up podcast on more of these topics, and love to check in to see how your portfolio is doing and what next steps are for your group as well. So with that, I want to thank you for taking time.
Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.